Okay, I want to welcome everyone to the last panel of the day. Just a little housekeeping. At the end of this panel, we're going to have a 15-minute break. And just as a reminder, that's going to be followed by dinner and a keynote address. And the keynote speaker for the evening is Governor Lael Brainerd. And so we welcome everyone to stick around for that. And to start off our panel, we're going to start with Jeff Larimore. He is a senior economist in the Division of Consumer and Community Affairs at the Federal Reserve Board, and he's going to tell us about the Survey of Household and Economic Dynamics.
All right, so good afternoon, everyone, and certainly thank you for including me in this important institute's opening. I'm sort of excited to be here and be sharing with you information about the work that I'm doing at the Federal Reserve Board, which is on the Survey of Household Economics and Decision Making. And what I want to do today is talk about, first of all, just what is the SHED survey, because I recognize that this is a relatively new survey in terms of the data that the Federal Reserve is producing. Talk a little bit about some of the things that we've been doing with the data, where we see some potential questions that can be answered with it, and then also thinking about sort of this idea of what are the opportunities out there for us to partner with this institute and with other researchers, so where are some of the potential extensions that we can go with it. So first of all, just some background on the survey. So the SHED is an annual survey on financial well-being that the Federal Reserve has been conducting each fall since 2013. This is actually exciting timing for me in terms of this conference relative to our data, because we actually just on Friday came out with our latest report on financial well-being, which covers the results from our survey in the fall of 2016. So I actually even have some copies here if any of you are interested in having that as a takeaway from this conference. But what is the SHED? So the SHED is designed really with three primary motivations. The first one is to monitor trends in consumer behavior and sentiment, particularly among low and moderate income populations. And the way that we then actually sort of implement this motivation is, first of all, by having an oversample of low and moderate income individuals. So to make sure that we have a substantial representation to be able to answer the questions we want to look at, we do have an oversample of people making under $40,000 per year. But also in thinking about the questions and the way that we design what's actually being asked in the survey, really trying to focus on issues that are going to be most impacting this particular population. So, for example, we have questions in the survey asking people who didn't complete a college education, what were some of the barriers that prevented you from completing that education? Looking at things such as people's economic fragility and their ability to handle relatively modest emergency expenses. So really trying to craft the question, craft the survey with that low and moderate income population in mind. The second motivation for the survey is to cast light on current issues in financial well-being. And here, as the survey is being designed, we actually try to reserve about 15 to 20% of the time in the survey each year to new modules and new questions that might be emerging and important for thinking about financial well-being. So a couple years ago, there was the first time, one of the early modules we did with this was looking at auto lending and thinking about what some of the issues are with car purchases and auto lending experiences. This year, we included a question thinking about the gig economy and people's experiences with informal labor markets, so Uber, Lyft, et cetera. And so really trying to make sure that we're actually able to be responsive to new issues as they're actually emerging relatively rapidly. And then the third piece is recognizing that we do have other great data sources throughout the Federal Reserve System, throughout the government and academia. So trying to really fill data gaps. So the SCF, which John's going to talk about, for example, has great information on wealth distributions. We're not trying to replicate that, but trying to really sort of fill some data gaps where there might not be other reliable data out there. So as I said, the most recent findings we just released on Friday. The data is not quite posted on the Federal Reserve's website, but it should be later this week. So we really are also trying to make sure that the data is open and available for researchers to use and answer questions that they're particularly interested in. before talking a little bit about some of the things we've been doing with it, the other piece of background on this survey, because I think it is, and the session is talking about sort of emerging ways we're using data, and this is a data set that's fielded somewhat differently than other data sets. And that's because even though, so we're starting with a random address-based sampling through our partner in the survey, GfK's Knowledge Panel, but the actual administration of the survey is completely conducted online. So they actually go out, they do the random address-based sampling to then find people who are willing to take our survey and other surveys and then actually administer these online. Now we recognize that this both comes with its advantages and limitations. So one of the limitations we recognize, certainly thinking about opportunity and inclusive growth, is this question of, well, gee, is this really a representative sample of everyone, or is it just people with computers? And that is addressed here by recognizing that not everyone does have a computer, so people who want to participate in the panel and are selected for it, but don't have a computer or internet, are then provided with it. The advantage, though, to us is that it does allow us easier ability to recontact people, follow up with them. So in constructing the actual sample, we have randomly selected fresh respondents each year in addition to our lower income oversample, but then also about a third of the population that we're interviewing each year are people who we interviewed in the previous round of the survey. So there is at least some element of panel component to it that we're able to then follow up with some of these people and see how well-being is tracking from one year to the next for some of the same individuals. As I said, this is a survey that really looks at a wide range of financial experiences and financial well-being. So just to give you a flavor of some of the topics that it covers, we include questions on overall economic well-being, on employment and the gig economy and informal labor markets, on income and savings behavior, banking and credit, economic preparedness, education, retirement savings. So really trying to cover a wide range of aspects of people's financial lives. So what are some of the things that we've actually been doing with this data? As I said, a lot of the things that we're looking at are really focused on the financial circumstances of people at the lower end of the income distribution. I think that if there's one question that people know from this survey, it's probably how would you handle a $400 emergency expense if it was to arrive, if you were to have one, and how you handle that. Something that we did, it's new this year, but trying to get at a similar concept, is asking people, are you able to pay all of your current month's bills, or are you expecting to have to make a partial payment on some of them, or simply not pay some of them? So when we ask people this question, we see that a little under a quarter of people, 23%, tell us that they're not expecting to pay all their current month's bills in full. But then we had this follow-up question. And we asked the follow-up question is, suppose you had a $400 emergency expense. How would that now impact your ability to pay? And through the combination of these two questions, we think we're now able to get this sense of people who are either living near the edge financially, so a relatively modest emergency expense would be a setback for them, or they're already living over the edge financially and they can't even pay their current month's bills. And so when we look at these two questions combined, we end up with 35% of people telling us that they wouldn't expect to be able to pay all their current month's bills if they had this $400 emergency expense. What we can then look at is breaking this down based on people's education and based on their race and ethnicity. And here we start to see the big differences in people's preparedness for these relatively modest emergencies based on their education and based on race and ethnicity. And even looking at race and ethnicity within education groups. So this is the fraction who, with that sort of the fuller set, saying that they would still be able to handle that pay all their current month's bills, even if they had a $400 emergency expense they also had to pay. And we see that as people's education increases, we see an increase in the fraction who say that they'd be able to handle this sort of an emergency. But we also then see, as I said, within each of the education groups that white non-Hispanics are more likely than black non-Hispanics or Hispanics to say that they'd be able to handle these sorts of expenses. Another type of thing that we look at is, which was really inspired this year in terms of new issues that we incorporated into the survey this year, really inspired by conversations about thinking about with Matt Desmond, thinking about his book Evicted, is what the experiences are of people who are renters, and particularly thinking of renters who are lower in the income distribution. And so we have some questions about the rental challenges by, we have some questions about eviction in there and whether people experienced eviction, but we also have questions asking them about their experiences with their landlord, and being able to get, the way that we're conceptualizing this and thinking about it is their ability to get problems with their rental unit fixed should they arise. And so we asked people, did you have any problems that you needed to have, that you felt needed to be fixed with your apartment or your house? Did you contact your landlord about them? And then this is now among people who contacted their landlord, what sort of challenges they had actually getting that problem resolved. And we don't actually see substantial differences by race and ethnicity in their likelihood of having problems or then contacting their landlord, but where we do see the big difference is is looking at their ability to get the problem fixed with just a little bit of difficulty or no difficulty. So whites are much less likely to say they had substantial or moderate difficulty getting their landlord to address these problems. And we actually can, we know in the survey the type of housing unit, we know the rent that they're paying, we also know things about their income and the various personal characteristics, and we still see these differences even when we control for all those other factors. So I think that this survey, these sorts of things that we're actually looking at with the survey that we think can be really useful as we think about some of the challenges among low and moderate income individuals. What are some of the potential questions that we think could be answered that we haven't been looking at yet? So one of the things that is particularly advantageous with this survey is that we have a lot of detailed information about higher education, including the actual school attendant. And so we can see in the data that you do have these big differences, not just in the likelihood of people going to college based on their family backgrounds, but also in the types of schools that they went to. So this can then potentially provide us additional insights into these questions of what the impacts of the types of schools that people went to are, and really trying to build off of some of the work that Philip was talking about, some of the work of Adam Looney and Konstantin Yannelis that looks at differences by the actual schools people went to, and really try to tease out some of these additional details on how the type of school people went to then plays into these additional roles, additional outcomes, even among people who actually went and completed a degree. A second type of thing that we could be looking at is what's contributing to people going into the gig economy. So as I said, we have these new questions this year looking at people's participation in informal labor markets. So how do people's financial circumstances and family backgrounds impact the likelihood of participating in these markets? What are some of the circumstances that might lead people into it? To what extent are they doing it because they're needing to smooth income losses from other sources? To what extent is it a choice that they want the additional flexibility? And also, should we be thinking about it as sort of a large single market, or are there differences in people who are participating in Uber and Lyft and that sort of market versus Airbnb and sort of renting out your capital and your property that you have? Or people who are in the offline markets and people who might have been previously doing this, but we just weren't really paying attention to it before these new markets started to emerge. And then a third sort of potential new question, just sort of trying to sort of spur thoughts about this data and things that we're able to look at, is this question of what's the relationship between family background and various well-being metrics. So we have information on parents' education. We ask about various things that you might have worried about as a child. So to what extent did you worry about food, having enough food to eat, having a stable family and stable caregivers, your personal safety, your family's finances, and how does that now relate to what people's outcomes are as adults? And we also have information in the restricted use version about the city and zip code where people actually went to high school to be able to get some of that geographic information as well. So finally, in sort of the last minute that I have, a couple of potential areas where I think there's potential for data enhancements, but would certainly welcome follow-up and questions and discussion about this. So because we're able to recontact people, it's possible to do focus groups and sort of deeper dives into particular topics of interest with subsets of respondents using this survey as a screening mechanism. As I said, we don't have detailed financial information as seen in the SCF or the CPS. We certainly don't want to compete with and overlap with that sort of product, but in the other surveys. But to the extent that there is value in being able to have some of that information in the context of other questions asked in the SHED, were there potential areas for there? We know that it's completely self-reported. We don't have administrative links to separately verify financial information. Again, to the extent that it's possible, are there certain administrative data that we should be trying to investigate and explore linking in? And then also using the flexibility that we have in the survey, are there certain areas that you as researchers say, this would be really valuable to be able to have in a nationally representative data set? So some of the things that we're at least talking about are CFPB now has their new financial well-being scale to systematically track well-being for demographic groups over time. So that would be something that we could consider trying to add an additional systematic dimension to this. How people are valuing their community amenities and thinking about community development activities. Adding information about financial knowledge and financial literacy, so things like the Anna Maria Lusardi questions. But then also just sort of, are there other topics of interest that, as I said, you as researchers say, this would be really valuable for us to be able to know more about, because that's something that we are actively interested in hearing about and knowing what the research questions are that you really think would be important to know more about. And so with that, I will pass it on and look forward to discussion and questions.
Okay, we're now going to hear from John Sabelhouse. He's an assistant director in the Division of Research and Statistics at the Federal Reserve Board, and he's going to talk to us about the Survey of Consumer Finance.
Great. Thank you, Stephanie. And thanks so much for inviting me to be part of this group. There's three of us talking about Fed data. And it's just a testament to what the Fed, I think, does on this front. There's in terms of testaments also, there's a lot of names on this slide right here. These are the people who are right now wrapping up the 2016 SCF. And I just want to thank all of them as I get moving. Okay, so what am I going to do? What is the SCF and how is the survey changing for 2016 and beyond? You just heard about SHED, which is very young and nimble. The SCF is a little bit older and slower, but you'll see we actually went through a redesign before this latest wave, and I'll be able to share some of that with you. I want to talk about using the SCF for studying the questions at hand today. And then some open questions that we could actually move on to for using the SCF. Finally, thinking about ways we can improve the SCF for studying inequality, opportunity, and inclusion, including access to the non-public SCF and the linkages to administrative data. So what is the SCF? So the SCF is a household survey with comprehensive balance sheets, incomes, demographics, work histories, and attitudes. Most people think of it as a wealth survey, and it is at its core. It is one of the primary micro-wealth surveys in the U.S., but it also has a lot of other features as well, which play into part of what I'm going to talk about. It is a cross-section survey, triennial. It goes back to 1983, but in its modern form, it goes back to 1989, or in its consistent form, I should say. There's a lot of things you can do that go back to 83, but certainly you can answer questions that are common to all the surveys from 89 forward. The SCF is well known for oversampling high-wealth families using administrative data derived from tax returns. This is what I'll refer to later as the sampling data. This is what allows us to know that we're actually talking to the entire distribution of families. We're not truncated at the top. Emmanuel mentioned earlier, one of the big problems with most surveys is they are truncated at the top. It's very difficult to reach and talk to high-income families, and that's part of what the SCF specializes in. And one of the other things a lot of people don't know about the SCF is that there's a very distinct trade-off between sample size and data quality. So in a relative sense, the SCF is fairly small compared to the survey, the current population survey, the American Community Survey, lots of other big public data sets. But every case that we see gets a very extensive case review based on interviewer notes. There's a facility for them to take notes while they're doing the interview. There's the sampling data itself, and then internal consistency within the case. And a lot of that review process bears on the sorts of things that we're talking about. So let me just talk about this data quality a little bit more. So the samples are fairly small, at around 6,000 households. So it is actually possible to thoroughly review every case, and that's what that group of people on the first slide have been doing for the past year. Every case gets a read that could be as short as 15 minutes, but it could be as long as an hour, where we're trying to reconcile and think about what's happening. And I think the title of Catherine's book was Making Ends Meet. A lot of times we're asking the question, how do people make ends meet? So for a wealthy business owner, this might involve focusing on how the reported wealth that they're telling us about and the reported incomes line up with or are consistent with the reported income on the sampling data. So we have their underlying tax data that tells us that they're probably rich, but trying to understand, and we can look back a few years and try to understand how rich they are is something which we'll go through a lot of storytelling and trying to figure out exactly what's happening with them. At the same time, we're also interested in the population we've been talking about all day, which is for low-income households, we'll focus on how their reported incomes, including transfers, line up with their reported spending, because we have some data on the rent they pay, the food they buy, and things like that. And so, again, a lot of it is about storytelling and thinking about how people make ends meet, and every one of these cases is going to get a very thorough review. So is the SCF just about the rich? So part of what I think people hear the SCF and they say, oh, that's the survey that covers the rich. And it does. The top 1% of the population is represented by about 10% of the cases in the SCF. So we're definitely oversampled in that direction, the same sense Jeff pointed out, SHED oversamples in the other direction. But there are several questions in the survey that are focused mostly on the finances of low and moderate income families. So, for example, we ask about financial support from others, we ask about loan payment status and bankruptcy history, and we ask about whether spending exceeded income and the use of payday loans. So these sort of regular features, things that we worry about in the finances of low and moderate income families, are things we ask about. And more importantly, there's an increasing focus going forward on the financial environment and decisions confronting what I'll call the non-rich. And this is the redesign process we went through after 2013. So a lot of people who are regular SCF users will have these new questions that you can deal with. We'll be releasing the data for 2016 in a couple of months. And for example, we have an improved credit demand and supply module. And this is where we actually borrowed from our friends. We'll talk to you in a few moments about the survey of consumer expectations, where they had a wonderful credit demand and supply module, and we implemented that directly. We also, with some of our other Fed colleagues at the Boston Fed in the survey of consumer payment choice, started talking to them about, when you're thinking about how people pay for things versus how much money they have, how much money is, what their cash flow is, not getting it right, how they're paying for things can actually really bias the survey. So we put in tracking of prepaid debit cards, which are becoming a much more prominent feature in finances of low and moderate income families. An expanded student loan module. We've heard a lot about education and the role of education and the cost of education, the cost of student loans. We asked some more detail about those loans. Another interesting set of questions, and again, Jeff was talking a little bit about what they do in SHED. We had one that's sort of similar, which is a prospective response to financial shocks. How would you react if something happened? And because at this point in the survey, we've already asked about their assets and liabilities, we know we can give them a list of things. If they tell us they're going to sell assets, we know whether or not they have assets, and the survey itself can adjust for those potential inconsistencies. We added questions about foreclosures that have been initiated in the current status. We added the financial literacy questions, the Anna Maria Lusardi, the big three, and an expanded retirement account tracking. I'll talk a little bit more about that in a minute. And then finally, one which I think is really, again, from a mobility perspective, one that I think we're really glad we made it on there, and we had really good response on this one, is asking people about their parents' educational attainment as well as their own. We now ask about their parents. There's a lot to look forward here in the survey in a couple of months. So now I want to talk a little bit about the SCF research and how it relates to what we've been talking about here today and in this conference. So there's a lot of attention that the SCF gets. It's focused on what I'll call the top shares literature. So Emmanuel was showing us some of this earlier, talking about what they've done in terms of Piketty-Saez and Saez-Zuckman, top income and wealth shares. What share does the top 1% have, the top 10% have? And we actually have contributed to that literature as well. We have a paper in Brookings last year using the SCF that compares and contrasts with some of the measures based on just tax data. And we actually find that the increases, although we find the top shares rising, they're not nearly as dramatic. It's about half as much at the very top as you get from tax data alone. And I would invite you to read that, and you could think about why these differences emerge. But the other thing that the SCF has been used for, and my colleagues Jeff Thompson and Gustavo Suarez have used it for studying determinants of wealth by race and ethnicity, and thinking about what is it that's led to the big disparities in wealth. Wealth disparities by race have been even more pronounced, have gotten even more pronounced than income disparities by race. There is other research that we've done that's focused on home ownership, debt, spending, retirement preparedness for especially the bottom half of the income distribution. And in these sorts of papers, we can do things like when people tell stories about the Great Recession and they talk about families taking on a lot of debt, especially Mian and Sufi, for example, low-income households taking on debt that they ultimately couldn't repay, that what we actually see was there was an explosion of debt across the distribution. And we know this because we can use the SCF. We can look across the entire distribution. One other thing on the retirement preparedness, we can use our data because we really have comprehensive measures of retirement. We have your DC accounts, your 401ks and IRAs, but we also have your DB pensions, and we can allocate that across households. And we could actually look at expected Social Security benefits, not what the respondents report, but what we can infer based on their own work histories. And you see things like, for example, the retirement industry will tell us that everything is fine because the ratio of retirement assets to income is actually stable. Well, that's not fine in an aging population. It should be going up. It shouldn't just be stable. And then more importantly, we can take our data, sort by our measure of permanent income, and we see that the retirement preparedness for the bottom half of the distribution has gotten much worse if we look at just private retirement assets, and you actually really see the role of Social Security in that. In terms of supporting retirement prospects. The SCF, the way we do these sorts of things, it's consistent with a pseudo panel analysis where everyone is a cross-section, but we can track various outcomes by birth cohort, race, education, and permanent income across the waves, and that's how we can do these kinds of studies. So what are some open questions? So I'll just throw a few up here real quick. Home ownership is we have a huge drop in the home ownership rate in the U.S., and it's captured in the SCF through 2013. I suspect we'll track as well for 2016. And the question is this because of a drop in demand for home ownership, because people have diminished income expectations, or is it something that the Fed is doing? Is it something the Fed or other regulators in terms of making it so credit restrictions or limiting access to home ownership? And if that's part of the issue, can we tell using our data with this comprehensive balance sheet and income what's going on? Education. So we've done a lot of work in the past on student loans about whether or not what's the trade-off between taking on the additional debt and increasing the income, because we can see both things. But we also can ask questions about whether there are barriers to access by race, ethnicity, and income, and what sort of changes like income-based repayment might be called for. And finally, one I think that is getting a lot of attention now and probably deserves even more attention is what is the role of things like home equity in terms of starting new businesses? So our colleagues in elsewhere on the board, what we would call the real side of the board, talk about the lack of business dynamism, the lack of new business formation. And the question is, what is it that's holding that back? Is it like home ownership in the sense that it could be credit restrictions? And if so, there may be policy answers. That wasn't it. I do have a couple more. So one is, and Emmanuel set this up very nicely, right, which is the distributional national accounts literature, which he has initiated, and I think it's getting a lot of attention. So people at Census are involved, and we're getting very involved now. It's a project that goes across sections. We have the micro data. We also, our colleagues in the flow of funds section have the financial accounts data to distribute. But the question is, how how can the SEF play its role of being this micro-level nexus between income, wealth, and spending, and really allow us to answer questions about how the distribution of production is actually changing over time. For example, when Janet was talking about the Medicaid expenses, we actually have, in addition to all our other data, we have, do you have health insurance through these various sources? So we can allocate that health insurance to the appropriate families. And build up these distributional accounts from a more micro basis rather than trying to piece together the distributions from different data sets. So the other one, which I'm really excited about, is what I'll call broader wealth concepts and sort of the value of social insurance. So we pay a lot more today for public health retirement programs. Most people don't know this, but Social Security is roughly double the size it was in the early 1970s in terms of replacement rates and in terms of taxes. It's gotten a lot bigger. And we're subtracting those taxes. Those are coming out of our income. It means income is not growing as fast, but we also get a lot more back in terms of benefits than, say, our grandparents' generation, not our parents' generation, but our grandparents' generation. And what that means, if you take the present value of Social Security benefits that are owed to people who've already started paying taxes, it's roughly $60 billion. Or $60 trillion. All household sector net worth is only about $80 trillion. So that it's an amazing amount of wealth that we're not counting. But with the SEF, because we have these earnings histories, there's a group in our section who's working on trying to create these present value wealth concepts to think about getting better measures of how wealth distribution is actually changing. So what can we do to enhance the SEF? So there's a few real quick ideas that have been floated around over the years. More sample size is one. I hope I convinced you at the beginning that the attention that goes into the data set actually does limit us to some extent. It's actually a pretty expensive data set to collect, but also to process. Adding a panel dimension has been considered, and it's been tried on a couple of occasions. The distinctive nature of the SEF is because of the way we use the sampling data to get the top makes this difficult as well. And it's also, the attrition in panels can be bad. If you have a small sample to begin with, it can really amplify that. So it's led us to really focus our attention on improving the cross sections. However, we are very likely to adopt an online survey component, and my colleagues here at the table are part of why that's true, that the SC, the SHED, and the SCPC, again, that's the Boston Fed's survey, are all done online, and it may make this feasible. Data access and linkage, this is when we're often asked the question what can we do with the SEF? Can we link it to other data? And the SEF is a pioneer in linking surveys and administrative data because the admin is used to really select and actually validate the high wealth sample. Or because of that, though, our memorandum of understanding with IRS says no additional linking that could lead to any kind of disclosure. And it leads me to ask a question, and it actually came up at lunch today when we were talking about how to use the administrative data to do things. And if you think about the SEF is a survey of people drawn from an administrative data set. And that, to me, is the future. And that's one that, we think about how to enhance our data sets, being able to start with data that already has a lot of what you want to know, and then you add those extra questions that you can't get from administrative data. In many ways, that's what the SEF already is. And so there are a couple different things we have going on. I'm out of time, and if you want to talk to somebody about these projects, the section is open to working with people on the outside. But a couple things we're doing is linking to local area geography, and then working with statistical matching. We can't do actual matching, but we can find like households in these other data sets, two of which Wilbert is about to talk about. So thank you very much.
Thanks, John. Okay, Wilbert van der Klauw, he's a senior vice president in the microeconomic studies function at the New York Fed, and he's going to tell us about the New York Fed's survey of consumer expectations and the consumer credit panel. Thanks.
Great, thank you very much. Thanks to the organizers for giving me this opportunity to talk about two major data collections that we do. Which are the Survey of Consumer Expectations and the New York Fed Consumer Credit Panel. So I'm going to give a short description of both of these data collection efforts. give some examples of the research we've been doing that relate to the issue at hand here about inequality and opportunity. Then talk about data access, data linkages, and potential enhancements to the data. So what's the survey of consumer expectations? Well, it's a relatively new survey. It's started in 2013, focusing on expectations using frontier methodology from economics, psychology, and survey design. Why do we collect expectations data? Well, first is to able to monitor people's expectations, for example, about inflation, expected wage growth, and I'll talk about a number of other variables that we're looking at. So that's obviously very useful for monetary policy. We're also trying to understand better the link between expectations and behavior. So that will allow us not only to better understand why people make the choices they're making, but also makes it easier for us to forecast what people will be doing in the future. We try to understand better by tracking people's expectations over time. The same people, we can see how they revise expectations, so we can see how they actually form expectations. So that might allow us to move away from more traditional rational expectations model to the extent that people act differently. And finally, the survey will allow us to collect evidence on some other time-sensitive topics of interest, and I'll discuss some of them. So again, in summary, the data is very useful for monetary policy, but also it gives a basis for a body of academic research on a topic that economists actually know very little about: expectations, how people form expectations, and they're very important. So main features of the data: it's monthly data. And collected since June 2013. It's a national representative sample. It's a rotating panel, so people move in and out of the survey. They stay in for 12 months, up to 12 months. So each month, one small portion rotates out and others come in. The core module has expectations about the economy and as well as the household. So it's inflation, unemployment, wage growth, home price appreciation, different types of expenditures, household income, taxes, government debt, government policies. There's a big range of questions on credit access and labor market transitions. And for many of them, we don't just collect a point forecast, what people expect to happen, we also look at the forecast distribution. We want to know their uncertainty they have about these expectations. Then on either 3 times a year or once a year, we have special models on special topics. So they kind of rotate at a quarterly basis. So there's credit access, labor market, the housing market, spending and savings, informal employment, family leave, student loans. So these are kind of some of the special topics that occasionally we want to ask questions about. And also these surveys will have some randomized experiments that we use for research. These are information experiments where we provide information to people and see how they update their expectations. And some other problem-solving experiments to see how people actually make choices. So while it's a relatively small sample, it's very rich data, right? We follow the same people over time. We see how they change their views, which is very useful. So you can split it by gender, race, ethnicity, age, education, income. So a lot of demographic variables, as well as a numeracy and financial literacy test that that all the participants complete. So I'll give you 3 examples that speak to the issue here about inequality and opportunity. And so the first one is about job finding expectations, and I show the patterns over time that we're collecting by education. We looked at what happened during the elections. There was a big increase in confidence. For example, in the Michigan survey, we looked at heterogeneity, about what was going on. And then another example is credit access, where we study people's credit applications. Did they apply for any credit over the past year? Were they accepted or not? And were there people who didn't apply because they thought they would be rejected? So we call them the so-called discouraged borrowers, which is not available from any other data that we have on the credit markets. So these are patterns of job finding expectations. So the question here is, if you were to lose your job in the next, lose your job, what's the probability that you will be able to find a job in the next 3 months? And so that's the mean of the answers that people provide. And as you see, there's been an increasing trend during this period for all education groups, but the biggest increase was really for those with high school or less than high school education. And we have these trends, as you see under the demographics bar. These are interactive charts, and you can split it by age, education income, numeracy, region, and of course with the raw data you can split it any other way that you would like. So this is what, when we looked at the same people, right? We interview them every month, and so we looked at the consumer sentiment. This is a question about whether they expect to be financially better off over the next year. And we looked at how people changed their mind after the elections. And then we split everybody in the sample by where they live and whether their county voted Democrats or GOP, or whether they flipped during the elections. And so what we see here, there was actually a lot of heterogeneity. So overall, there was an increase in confidence that shows up in the kind of Michigan survey. It also shows up in stock market expectations, where again you see a little bit an asymmetry. But what you see here is that in the counties where that voted Democrats, you see actually a decline in terms of this measure of confidence, and a big boost that was really coming out of the more Republican areas.
What does flipped mean?
I'm sorry?
What does flipped mean?
Flipped, well, they used to vote Democrat and they went to Republican, or the other way around, sorry. So they basically, from the previous general election, they switched. This is from our credit access module. And so again, here we ask people, did you apply for credit? And were you successful? The green bars are people who applied and were successful. The red section is people who applied and got rejected. This is for any kinds of credit, but we also split this by credit cards, auto loans, and mortgages and mortgage refinancing. And so what you see here, and then we split it into 3 groups by their credit score. And so what you see is that for those with high credit scores, vast majority of applications are accepted. For the middle credit score group, you see a little bit more rejections. And then on the left, people with lower credit scores, high rejection rates, but also the blue sections are a high proportion of people who say they need credit, but they didn't apply because they expected to be rejected. So we report monthly releases from this survey online, and we have press briefings press releases every month. The microdata are released to the public and they're used for research and after initial embargo period. Currently we have no data linkages. We were exploring linking the SC to credit report records. Now we're very open to new questions, and we do get questions from other colleagues in the system as well as academic researchers, and we've been trying to be quite responsive to that. We would like to increase the sample size. Currently it's about 1,300. We also would like to include spouses in the survey, and as was mentioned earlier, family context matters. We want to know how inter-household decisions are made, and for that you really need to get the views of spouses and partners. Okay, now turning to the second data collection, that's the consumer credit panel. I think many of you might have heard about this. But it's a quarterly panel of individuals and households. This data is based on Equifax credit reports. We started designing this just after the financial crisis. I wish we had this before, of course. But so what we have is what is typically on credit reports, right? We have mortgages, home equity lines of credit, auto loans, credit cards, student loans. And so for each individual, we have aggregates for that, as well as for certain loan types, we have each individual loan. And so you can look at individuals over time, you could look at loans over time, and we have this data going back to '99. We have public record information, so that has foreclosures, bankruptcies, tax liens, and individual characteristics, not so much, right? There's not much on the credit report. I mean, we know people's age. We know their credit score, which is a good proxy for income, household composition, and where they live. So that's important. We know their state, their zip code, and even their census block. Okay, so the sample design, we have a 5% representative sample of individuals with a credit report, which after age 18, 19, it gets, you get very quickly to very high in the 90s. So that's 13 million individuals. So this is big data, right? So these are very rich, detailed data on 13 million people. Then we pool the credit reports of everybody else living at the same address. So we can look at the household. So that makes the sample 47 million individuals. And that information is updated every quarter. And so, as I mentioned earlier, it started in '99 and it's still ongoing. So what's really unique is about the sample design, the way we pool people, is that we pool the same people over time. So we have a panel, and it remains representative. So as people take out their first loan, they enter the panel. If they're immigrants, they come in and they take out their first loan, they enter the panel. And when people die, or when they emigrate, they leave the panel. So at each point in time, it is representative, so you can aggregate up and compare to national statistics. And of course, besides knowing all their debts, we also know their status on these debts, their delinquencies, and so on. So there's a lot of uses of these data. Financial behavior, entry into home ownership, household formation, because we see who they live with. Home equity extraction. We've done a lot of reports on subprime auto and credit card originations and delinquencies. Geographic mobility. Your credit report goes with you wherever you go, so there is no attrition, so you can see where people move. And we looked at the impact of natural disasters like Katrina and Sandy. We also recently used it to look at Puerto Rico, which is in our district, to look at the problems there. Okay, so it's a huge sample, very rich longitudinal information, few demographic variables, so there's no gender, race, and so on, and there's no income, although we have credit score. But because of the great geographic information, going all the way down to the census block, you could match it to statistics at the geographic level, and that's what we've been doing. So 3 examples. Shifts in mortgage borrowing by credit score. So this is really about the tightening of credit in the mortgage space. Then we looked at what's going on in oil-producing countries after counties within the U.S. after oil price collapsed, and then student debts. So this is the distribution of credit scores of newly originated mortgages. And so the 10th percentile is the lowest one shown here. So, so what we see now is that only of all newly originated mortgages, only 10% are for people who have credit scores lower than 650. And in 2006, that was almost 25% who had credit scores below that. So there was huge tightening. And as you see during the recession, the whole distribution moved up. And it stayed kind of up there. It really hasn't really come down, so there's still conditions are very tight for people with low credit scores. This is where we compared mortgage delinquency rates. These are 90 days delinquency rates for the US, which is the light blue line here. So you see this huge increase in delinquencies after the financial crisis and the recession. It's been coming down steadily, and then you see the same for oil-producing countries. So here we looked at the proportion of employment in a county involved in mining and gas and oil extraction. And so those with a relatively high proportion are in that dark blue line. So there are more rural countries that in the past they used to have higher delinquency rates. They didn't have much of a boom-bust. So there was an increase in delinquencies during the recession. And then it's flattened out after 2014, when oil prices started going down. It kind of flattened out, so now they're actually coming together. When you look at auto loan delinquencies, they're actually very similar in these oil-producing countries compared to the rest of the US. But then after 2014, you see an increase in delinquencies for auto loans for these oil-producing countries. So that's some early signs of stress in these areas. The final example is student loan delinquencies. So what we do here is we look at 3 cohorts, and we look at 5 year after people leave college. We look at their status of the student loans that they took out. Okay, so, and we're going to look at what proportion of those are delinquent, that's the blue bars, are in default, that's the blue bars. The red bars they are delinquent, they haven't defaulted yet, but they're more than 120 days late. And the green bars are the proportion of people who haven't paid back anything. So their debt has been sitting there, probably growing because of interest accumulation. They might be in income-based repayment programs and not making any payments. So what this is showing is, first of all, that 2009 is by far the worst cohort. And so very, very high delinquency rates. And then on the horizontal axis, we now divide all the borrowers by the average income in the area, the zip code that they live. And so what we see here is that the highest delinquency rates are in the lower income areas, and delinquency rates and default rates are really spectacularly high. And we've looked further at this problem, and part of it is dropout, part of it is the schools they went to, so a lot of them do go to these for-profits, and that's why we get very, very high delinquency rates for people who went to for-profits. Community colleges actually also have very high delinquency rates, and the dropout rate, of course, is a big problem. So we have, data releases every quarter. We released our last report last week. It got a lot of attention again because we crossed the total debt balance that we had in 2008. Last, it was the kind of peak level. Now we cannot post the microdata. The vendor doesn't allow us to share that, but we put as much data out as we can. So national, state, county statistics are used a lot in research. Within the system, everybody can use the microdata as well as co-authors that can share the data. There are already over 150 research papers, policy briefs, and academic journal articles. It's kind of exploding how many papers use these data. Links, okay, well, there's been a lot of efforts to link these data with other data sets. Some of the results I was just describing about splitting it by college, we also split it by college major and so on, comes from matches that we did with National Student Clearinghouse data. We also matched the data with for students who went to the CUNY system, and all the students in West Virginia, their transcripts data were linked as well. Then there are a lot of matches with mortgage type data from loan performance, LPS, HMDA. HMDA has the race of the applicant, and so there's work on that where you can look at how the credit tightening differentially affected minorities. And Neil-Buddha has also linked the data with payday loan applicant data. So there are a lot of linkages already. We hope to link it to earnings records because then we can really look at unemployment shocks and look what happens with people, and also link it with the small business owner data. That's it.
Okay, our last panelist is Rob Morin. He is the director of the Minnesota Population Center, and he's going to talk to us about his ambitious IPUMS project.
Thank you, Stephanie. It's IPUMS. Let's all say it together. IPUMS. Welcome to Minnesota, for those of you who are from out of town. Help here, just forward. Yeah. So I'm going to talk about, we're going to change gears. I'm going to talk about something a little different. I'm going to talk about the past, present, and future of microdata for research on social inequality and for opportunity and inclusive growth. The focus is going to mostly be on the IPUMS collection, but also on other Minnesota Population Center related data collections, but I'll touch on some broader things. I'm not entirely sure what you all know. I suspect that many people know some things, but not everybody's going to know everything that I said, so hopefully everyone can take away something. And I'm not going to show any results. I was fascinated by the results on the last talks, but I don't have any results for you. I'm going to let you, at the end, though, imagine your own research, and then you can also imagine results, if you like. So I'm going to talk about the past, the present, and the future. In talking about the past, I'm going to talk about integrating historical microdata, and I'll tell you why that's useful. When I talk about the present, I'm going to talk about the IPPM CPS collection, the Current Population Survey collection. And when I talk about the future, I'm going to talk about ongoing record linkage initiatives at Minnesota, but also around the country, and how those things are connected. That's very much future-oriented. So let's start with the past. When I was in graduate school, and probably when many of you were in graduate school, this is how you found data, right? The data were described usually in binders, the code books, and you had a different one for each data set, and there was zero effort or ability to compare them. So here is a page from the 1900 US Census. It's the variable describing people's relationship to their head of household. And in 1900, there was one variable that described that, and it had 72 different categories. In 1980, there were only 20 categories, but it was in 2 variables. If you were to try to reconcile those two, to study trends between 1900 and 1980, most of the time of your research would be in trying to construct that variable. That's what IPPMS is, of course. This is the IPPMS, you can't read that, you don't need to. This is the IPPMS variable describing people's relationship to their head of household in every census from 1850 to 2000, and then also in the American Community Survey every year. It's done for you, you don't have to do it anymore, which should facilitate a lot of research. We have census microdata for every census from 1850 to 2000, 1890 burned up in a fire, and 2010 and 2020 there was no long form. And before 1850, it was largely a household survey. There wasn't individual level data. In recent decades, since 1960, that's just reiterating what I showed you a minute ago, we have census microdata from 1960 to 2000. The IPPMS collection, the IPPMS USA collection also includes the American Community Survey every year from 2000 to 2016, and the Current Population Survey from very early on, also to 2016. This is just the US, though. IPPMS actually has a large international collection. The blue countries are countries for which we have obtained census data, usually in multiple census years, and integrated them with the IPPMS USA collection. So this is the how are you related to the head of household variable across 23 African countries in the most recent census for which we have data. It's fully integrated with the US data. Right now there are 89 countries so far. We have people traveling the world, negotiating with international census bureaus. 336 samples, so about 4 censuses for most countries, ranging from the year 1701 to the present. But these are just censuses. I said a little bit about things that are not censuses, the American Community Survey and the Current Population Survey. IPPMS now also includes other data products that you probably want to know about. One is the demographic and health surveys, which is one of the main ways that we know about the health and well-being of women and children, childbirth outcomes, and things like that in developing countries. The IPPMS collection now includes India and 20 African countries. Again, measures harmonized across samples and over time. We generally have 3 or 4 DHS surveys for each of these countries, and we're expanding as quickly as we can. IPPMS also includes a population and environmental data collection. Here, the goal is to integrate population data, such as the censuses, with land use data, land cover data, and climate and environmental variables, such that they are fully interoperable. You don't need to figure out how to match them. Often at very low resolution geographically, and comparable, of course, over time and place. This is the full IPPMS collection. I haven't said anything about the higher education surveys or the time use surveys. Those are also interesting, but perhaps of less interest to this audience. This is how much microdata there are now in the collection. We have about 3.5 billion person records, we have a little over 3 billion now. We're headed to 3.5 billion person records, all freely available, all well documented on the internet. We have about 147,000 users. We distribute about 3.6 terabytes of data per week. And the data, the IPPMS collections, one data set or another, are cited about 2,000 times a year, which is a new paper about every 4 hours, including at night. So that's the past. That's less interesting. Let me talk about a current product, a recent product that you probably should know about or you should tell your colleagues about. And this is the IPUM's Current Population Survey collection. I'm sure all of you are familiar basically with the Current Population Survey. It's a sample of civilian household-based individuals. Every month there's about 140,000 people in the survey and about 70,000 households. The basic survey every month includes information about labor force behaviors and basic demographic information. And of course, there are supplements in almost every month on things like education or food security or civic engagement and so forth. And then the supplement that gets used the most is the annual social and economic supplement, which has detailed information about income, poverty, and other social and economic characteristics. You know the basic design probably. If your household is selected to be in the Current Population Survey, say in January, your first month in the survey is in January. You're then re-interviewed every month for 3 months. You're left alone for 8 months, and then your 5th through 8 months in the survey are in the same 4 calendar months in the following year. So it's a 16-month longitudinal survey, but where you're just left alone for the middle 8 months. And then, of course, another panel comes in every month, and so forth. Most people use the CPS as a cross-sectional survey. So you could compare the United States in January of a year to the United States in February of a year. This is where, the unemployment rates, essentially you're doing repeated cross-sectional analysis of current population survey data. Some people compare across years, perhaps most often with the annual social and economic supplement, the ASEC. People will compare from March to March, although it's technically not always March. A difficult thing about doing this kind of analysis historically has been to do a March to March comparison. You have to go get both March surveys, and you have to read the documentation and figure out how the data changed across the 2 Marches, and that can be tricky. We have taken care of that for you. Does anybody recognize this webpage? Anybody? Yeah. I love this webpage. I used it for many, many years, and I don't use it anymore. It's the NBER website where you can get CPS supplements and the documentation, and it's really impressive in how much is there, but it's really hard to use. Not because of the website design, but because what you're really getting are PDF files of the raw documentation, which you then have to work to sort through to try to figure out how to code each variable. It's a wonderful resource, but I think its time has come. The other place you might have gone would be the Unicon utilities. I had to go to a historical website archiving service to get this. It doesn't exist anymore. So no longer do we have the Unicon CPS utilities, which is where IPUM CPS comes in. We've integrated and fully harmonized and well documented and produced for free for people to download CPS files. The basic monthly survey is from January 1976 through the most recently released basic monthly survey in March of this year. The ASEC supplements from 1976 forward, and we're working backwards as well. Again, where all the variables are measured consistently over time, recoded with good documentation about changes in question wording and universe and all of that, but meant to make analyses over time vastly easier. We've also treated many other supplements in this way. The ASEC, I think, is of most interest to this group, but we've also done this to most of the most commonly used supplements. And we're doing them in the order with which they are used. So we're trying to do the most commonly used supplements first. So none of that said anything about the longitudinal capacity of IPUM. So remember, it's a 16-month longitudinal survey. And what that means is that in any particular, if you were to do a March to March comparison, you have 4 rotation groups that were interviewed twice. That's complicated. It gets hard to think about that, particularly if you're linking or trying to link supplements that aren't in the same calendar month. You get this very complicated rotating panel design. And then you also have to think about the same issues of comparability of measures over time. We've taken care of that as well. We have gone to the trouble of linking all CPS records from 1976 forward. So we've linked all the basic surveys to the degree that they can be linked, right? The rotation group design is such that some people this month are not supposed to appear in the CPS next month, but we've linked everyone who should be linked from 1976 forward for the monthlies, and for most of the supplements. ASEC is a little trickier for technical reasons, and there we've linked from 1989 forward. Again, these are all freely available on the IPPMS website. We should begin to think of CPS, and we should always use CPS now, as a short-term panel study of 16,000 household-based people with a fresh, large sample starting every calendar month over 40 years. This is an amazing longitudinal data resource where you can study short-term change within people's lives and then look at 4 decades at least of historical change in those short-term changes within people's lives. It's a much more powerful data resource than people have been able to use it as to this point. Let me talk about the future. And these are things that are on the drawing board, but that will be here in 5 years. And these are the kinds of things that we will all be using 5 years from now, or maybe 10. So, as I said before, we have census microdata for censuses from 1850 forward. Those of you who have used census data know that you very often are restricted to having like a 5% sample, or for some of the older samples, a 1% sample. Those days are gone. We now have 100% microdata for 1850 through 1940. So we don't need to deal with samples anymore, which is very useful for a variety of purposes. What I want to talk about are 3 initiatives going on around the country. MPC has some role in each of them, although some are not mainly our initiatives. The first is the IPPMS Multi-Generational Longitudinal Panel. This is an IPPMS product, or will be an IPPMS product. The idea here is to link all census data from 1850 to 1940. So longitudinal data on everybody over 90 years. The second is CLIP, the Census Longitudinal Infrastructure Project. Many of you probably already know something about this. It's run by the Center for Administrative Records Research and Applications at the Census Bureau. In a nutshell, the idea of CLIP, first of all, is to link the 2000 census to the 2010, the short forms, not the long, there's no long form in 2010, but also to link that to 1940, which is in process, ongoing. That's a powerful data resource. But then, of course, the main idea of CLIP is to then link that to all federal surveys like the CPS or SIP, and also federal administrative records, anything that has a social security number or an alternate taxpayer identification number. Some of these things are more difficult to do than others, but this is the vision, right? The vision is that you have fully linked census records across those 3 enumerations, linked to federal surveys and to federal administrative records. The third initiative is the American Opportunity Study, which is led by David Grusky and colleagues at Stanford, but also some other people around the country. The vision here, first of all, is to link, first you have to digitize, but then link census records from 1960 through 2000, and then plug that in to the same set of federal surveys and federal administrative records. So each of those is partial, but those 3 groups are collaborating. And 5 to 10 years from now, what we'll have is this. We'll have the IPPMS Multi-Generational Longitudinal Panel, plus the CLIP, plus the American Opportunity Study. And what you have then is longitudinal data on virtually everybody from 1850 forward, all plugged into modern federal surveys and federal administrative data. And of course, there's hoops to be jumped through, and there's all sorts of logistical things that have to be worked out, but there's no reason not to plug in your own survey data, right? So a person like me, maybe, who gathers, I'm a sociologist. If I do a sociological survey where I have identifying information about individuals, conceptually, that can be plugged in to this apparatus. So I can have information from administrative records, but also historical information about people's families going back to 1850. So I'll pause here and let you imagine what you would do with these data. Right? I don't have any results, but if you had longitudinal data on everybody from 1850 forward, plugged into all manner of federal survey and administrative data, what would you do first? Pause. Imagine that over dinner, perhaps. Let me leave you with 2 take-homes. The first is, if you're analyzing CPS data, and especially if you're linking CPS records over time, you should use the IPPMS CPS collection, or you should at least consider it. It will vastly simplify your effort to produce longitudinal analyses using the CPS. And second, a general point is that data silos are crumbling. Data are becoming interoperable and connected. it's time, I think, to reimagine what is possible for research on the kinds of topics that you all have been talking about today. Because as silly as it seemed when I was in graduate school to think about having the IPLMS collection, I think 10 years from now, we will think of it as sort of outdated to not think of all data as somehow linkable and easily linked. I think that's it. Thank you.
Okay, so this is normally where I tell everyone that they can start asking questions, but actually I'm going to use my role as the moderator to engage your attention for a couple more minutes. When we were talking with the organizers of the panel a month or so ago about the panel and what we wanted to talk about, one of the things that struck me was that there wasn't someone on the panel to talk about the administrative data resources within the Federal Reserve System, and also the efforts to use what we commonly call big data at the Federal Reserve Board, and we've made a really big effort in this direction. And since this also seems like, in addition to the survey resources we have, one of the areas where we have a lot of ability to produce new and interesting data and really to be on the forefront of where we're going with data and data technology, I thought it was worth it for me to spend just a couple of minutes to be like, and don't forget about these things. So we tried to get some experts in. I'm not the experts on these data, but I didn't want to get lost in the, that in fact, there's a big effort on this in the system. So the system has access to a wide variety of administrative data that can be used to examine issues related to economic inclusion. Actually, Wilbert talked about a lot of this already. Not all the data are equally useful in terms of providing data on gender, race, and ethnicity. A lot of them do have very detailed geographic data, which can be used to get at similar issues by linking it up, say, to county level data or even census tract data. And as he also discussed, there are opportunities to match across the data sets. So for instance, he talked about the work that Neil Buddha has done with some co-authors. The HMDA data have information on race and ethnicity, and there's been an exercise matching those to the consumer credit panel. And that just increases the usefulness of these data for looking at issues related to economic inclusion. It's also worth pointing out that we already have a great infrastructure within the system for using these data. So for instance, the data on mortgages and consumer credit for the system are all available through the RADAR system, which makes it very easy to access these data. And I think one of the things we should be thinking about, and at Kansas City they are thinking about, is how to make even more data available easily to people throughout the system. So the board, and I'm sure there could be efforts going on about this at reserve banks, but I don't know about those efforts, so I'm sorry if I'm leaving out an important effort, but I'm just going to talk about big data efforts at the board with which I'm familiar. So we've got a big, push now to try to explore the usefulness of big data for our policy work and analysis. And from that, we've also been able to start doing a lot of interesting research using these data. So for instance, First Data provides credit card transaction level data from the firm. So it's where the transaction takes place, and that includes a lot of geographic detail. So we've been able to look at issues like how has weather affected consumption and spending in different states, and we're trying to explore whether those data will be able to get more individual level data about the people making the purchases as well as the transactions themselves, and looking at opportunities to link up these data with other data sources that can help to make them more useful. We're also looking at the ADP payroll data. So these are individual employment records that include information on gender and age, along with the detailed information on earnings, hours, taxes, and extensive benefits data. We're also actually looking into a relationship now with Glassdoor, which is an online jobs posting data source, which has detailed information about the skill requirements of postings. So these are just sort of the sampling of the types of data that we're exploring using, which I think are particularly pertinent for the types of research that people here are interested in. I think one of the big tasks for us now actually goes back to some of the issues that Philip raised with the data that he's using, which is carefully understanding what's the a lot of times you have a population here, but what exactly is that population? What's the selection in terms of who who the population is generating these data, understanding the selection, understanding how the data are constructed. So we're also facing similar issues where a lot of times the data come to us as a black box that a private company has already manipulated, and trying to understand exactly what those data consist of. So there are lots of challenges we're facing using those data, but we're gaining practice. You're trying to use them and exploring, understanding what we don't know about them. So I just sort of wanted to say these efforts are out there. A lot of them are, very well developed, our use of a lot of the administrative data. Some of them are more in their infancy, but it's definitely something to keep our eye on as we look to do further research on economic inclusion, to think about how we can make use of these data sources. And with that, now I will open it up to questions. I think I see, Bob.
I want to channel a question that actually Glenn Lowry should be asking, and
He's like, me?
this has been a fantastic, for any of us who are data hounds, a fantastic panel. I want to comment on one narrow thing, which is that it seems to me that measurements of network connections of individuals are vastly under-investigated or under-measured in this domain. That's the jargon I use for that is social capital, but I'm not trying to push social capital. I want to just give three quick examples of why, for this purpose, the Fed ought to be interested more in network connections of the people that you're measuring interest in. One, labor markets. We know that labor markets are filled with the importance of social networks. That's been talked about here. I'm just, because I'm trying to be quick, I will just leave it there. But social networks are crucially important, even in the age of the internet. Social networks are crucially important for job placement. Two, how to deal with financial emergency. I don't know how much data are currently in those wealth surveys about networks, but I'm willing to bet you quite a bit that many people, especially in the lower parts of distribution, their main resource, if they had a financial crisis, $400, is not to go to the bank and borrow $400. It's to call mom or call dad or call an uncle or even non-relatives. So I believe that for those sorts of, that for responding to financial emergencies, for many people in America, social networks are actually the first line of approach. Thirdly, and I'm going to be summarizing very quickly a research that I reported to the Joint Economic Committee in Congress last week. We know that a lot of people are going to retire. We know that that's going to be costly because they're going to need elder care. We know that currently the best estimates are that 3/4 of that elder care today is provided informally, not in the marketplace, but by cousins or children or spouses or churches or whatever. What we also know is that the boomer generation, which is now about to retire, has on average, and this is where I can tell you a lot that lies behind this, have on average 30% fewer social connections than their predecessors. They have 12% fewer spouses, they have 35% fewer kids, they have 40% fewer they have 30% fewer friends, close friends, and they have 40% fewer ties with religious institutions and so on. So what that means is that our current estimates, the best current estimates, taking into account that there are going to be a lot more boomers, the best current estimates assume that the boomers will have the same amount of informal social care as their parents. But that just is extremely unlikely to be true because they're entering that on an age-adjusted basis. They have about 30 to 40% fewer social ties than their parents did at the same age. And that means that the 3/4 of currently informally provided elder care is going to be cut roughly by 1/3. And what that means is that 1/4 of elder care that is currently provided paid, that's home health care aides and it's long-term care and so on, is going to have to double because we've got to make up the missing quarter. Is the math of that clear? And that means that, for example, projecting the future of Medicaid, which is the main way in which we pay for long-term than any public way in which we pay for long-term care. The current estimates account for the fact there are going to be more boomers, but completely ignore the fact that the boomers are going to be arriving there with many fewer social networks. I talked too long, but what I'm trying to say is I think for a lot of problems that you guys care about, you should be systematically gathering some kinds of data on social networks, the social networks of the people you're already interviewing.
Can I? Just a quick comment on sort of two of the things you mentioned there, just because they actually, first of all, 100% agree with you in terms of the importance of all of the various social networks and being able to capture that. In the shed, we do a little bit of that. So for example, with the $400 question, you're absolutely right. So for people who say that they would not pay for a $400 emergency using cash or credit card to pay off at the end of the month, the most common way that they'd be paying for it is with a credit card that they're going to then pay off over time. The second most common way is by borrowing from friends or family. So I think you're absolutely right that that is an important component of a lot of these issues. I think that in terms of sort of the aging baby boomers, again, I agree with you, certainly for our survey in particular. One of the things we're interested in more is the way that people are interacting with people outside their household for assistance, providing assistance, receiving assistance, et cetera. We do actually, for people who are living with their parents and think about the living arrangements, one of the things we actually added this year, precisely for that reason, is asking people, why is it that you're living with your parents? And as you expect, a lot of people are doing it to save money, but we actually do see a non-trivial fraction of people that are living with their parents in their late 20s or in their 30s are saying they're doing it in part to provide assistance for those parents. It's not always the child that's receiving assistance. There's also some assistance going in the opposite direction, which includes both the financial as well as the health reasons. So I think that you're absolutely right that these are important issues we need to be thinking about. I don't think that the shed goes anywhere near far enough yet. I think that sort of the outside this home part is important, but you're right that those are important things to consider.
So Warren talked a lot about the future of linking different data sources together. So one area that I didn't hear anything spoken about, which I think is A, crucially important for if we understanding labor market inclusion, and B, where other countries have been much more successful, is firms and linking individual people to firms. So I was wondering if there's EPUMs. I'm one of the people who's an extensive user and just found out today how to pronounce it.
If you like.
You need to put a thing on the website with how to pronounce it.
It's there.
It's there? Busy downloading data. Or the Fed. Are there any efforts or ideas about how we can do better in that area?
IPUMS doesn't have any plans to link firm-level data, but it doesn't mean it's not a good idea or something we shouldn't do.
So I've worked on other projects that are fortunately not based on our data. A lot of these live at Census or Social Security. Fatih is here. And we, for example, have used the employer identification numbers on earnings records to kind of assemble firms and think about earnings dynamics and the relationship between firms and individuals. And Census really is the hotbed of this. John Halterwanger and his team. There are some Fed researchers who do work on this. But I think you're getting into some of the most confidential data, and that's where some of the issues. And I love Rob's dream, but you also do run into confidentiality when you start pulling these things together. I know with IRS, we, for example, have to be very, very diligent about how we do things.
So yeah, we've done a limited exercise where we linked the CCP, the individual credit reports, to similar data on small business owners. So there's more the business side. So we can look at trade credit, delinquencies on those, and bankruptcies and so on. But it's not. There's the information there on how many people work at the firm. It's somewhat limited. Their revenues and so on is kind of limited. But we are actually working on expanding that. We were close to getting a deal, and the contract fell through. We're trying again. So stay tuned.
I was just going to add that board is looking into becoming a research data center for the census, and a lot of other Federal Reserve banks have already done it or are also looking to do that, and I think that will make those data more widely spread. But as John said, that one of the big hurdles you have to get over is getting IRS approval for the project, and that's just very difficult. I have an economist in one of my sections who's been waiting for, like, the project is approved and the IRS has taken like over a year to actually like say he can use the data, so that's a big hurdle. I think I saw someone back there, yeah, first. Yep.
Well, first, I'm really grateful to Professor Putnam for his comment. Okay. And I just wanted to comment that I'm at the University of Minnesota, and I think we're probably within the next 2 years going to identify really sophisticated social network analysis as a core data analytics skill, along with regression analysis kind of thing. So I'm really grateful for your comments. I'm also thinking about all of these, the extant data sets that you're talking about. And during the break, some of us were talking about just the enormity of the problem and where do you go next? And I keep thinking that when we have access to these data systems, might it not give us the opportunity to ask better, more precise research questions that really do lend themselves to experimental or quasi-experimental design? Because I think sometimes in higher ed, we're shooting in the dark with our experimental questions, when in fact these data systems could point us in a more precise way to some really important questions. So in an entirely different context, there was a huge analysis of extant data around wages of male and female engineers and people in higher ed and engineering, and it led to a blind study of analysis of tenure dossiers, where they took all the names out and realized that the exact same dossier was nominated for tenure if a name attached to it was Donald, and not when it was Donna. And that study didn't come about until they did an analysis of the data system. So I'm just wondering if any of you would comment on the opportunity to think more surgically about experimental design as a result of this. Rob, you've got to see places at MPC where it leads to this.
I'm not on that example, but yeah, when you have massive data sets, you have the capacity to do very targeted analyses of particular population groups.
I would use it as an opportunity to plug what I was trying to say at the end when I was rushing, which is when I think about a survey, the best type of survey is one where people don't have to sit through it, right? Because we have a lot of trouble collecting data. CPS response is down. All of the major public use surveys, the response rates are way down. But imagine starting with something where you know a lot of the information already. It doesn't speak too much to your example, but there are just gaps you want to fill in. There are questions you want to ask them. Imagine starting with credit bureau data and pulling a sample from that and asking them questions about how they got into the situation they were in. And you don't have to tell them what you already know about their credit bureau data. You just want to ask them some new questions. That, to me, is the future of the administrative survey data linkage going forward.
Yeah, also I really appreciate this session. I'm a big user of all this data, so really grateful. Even though sometimes when I was a graduate student, some people told me data are like sausages. You want to use them, you don't want to know how they're made, but it's useful to actually know. But I have a question especially for you, John, about the SCF. You said, because data quality is a really big issue, measurement error so it's really useful that you actually go through, and you say sometimes spend an hour with an answer. But what do you do if the answer, do you go back to the household, or do you just...
We have been known to go back to interviewers, and this might be questions sometimes of a digit. So, did you really mean 100 million or 10 million? And to get those kind of answers. But yeah, I mean, it really is about getting the story to fit together, and all across the income distribution. And I will say also, this is something where Emmanuel's work on using the tax data, with Gabriel in particular with the wealth, has helped us to refine some of what we do and how we look at the data. And we've actually designed programs now to help pre-process the data and raise flags for us and things like that. So it's not a perfect science, but it's one that I think is pretty well honed. Arthur Kenneckel is the one who put a lot of these systems in place, and we inherited. And I think that really is one of the strengths of the data, is the fact that somebody has looked at it and said, yes, I can understand how this financial situation exists.
Another question for you, John. You mentioned earnings histories and permanent income, and do you have panel data from the tax records on income of the people in the SCF that is public? That's new to me. So
okay, so this is, and I'm glad. Thank you. This is a great question. So there's a couple things going on. So we actually have a measure of permanent income, which is your usual income. So we ask the respondents, we get their annual income, but then we ask them, is this different from what your income usually is? And you can take the gap between their actual income and their usual income and do a variance decomposition on it, and it actually looks like the sort of income variability that people like Fatigue get when they look at earnings records, actual longitudinal administrative data. So that's a nice feature. So that permanent income measure is a great classifier. And you'll see in papers that I write using the synthetic cohorts, we use that as a classifier. So that's one answer. The second answer is that there's work underway with, again, the group of people listed on that first slide, where in the SCF we ask questions about your earnings history, not the entire thing, but highlights of it. How many years you've worked, what you did, your top jobs, things like that, when you started, what you earned when you started these jobs. And they're going back and effectively taking other data sets and statistically reconstructing earnings histories, right? So the third answer, and so that is something that they want to create a lifetime earnings measure, not just a permanent income, but a lifetime earnings measure, because that's what you need to know in order to compute things like how much are they going to get from Social Security, so which is a key, as I said, a key element of wealth. And what was the third answer? The third answer is we do, for the group of people who is selected, for that 10% of the records who's selected through the list sample to get the high wealth, we know things about them going back a few years. And so what you get as an SCF user is an inference about their current income, which is not based on just what they reported, but it's also based on our interpretation of those few years of data. We probably could never do anything with that. It would be in violation of the MOU to ever try and publicly release that. But you can be assured that that data is being used to actually produce the final data set.
Alessandra Fogli here at the Minneapolis Fed. So not only have been using a lot this data, but also been trying to do geography over time, which is still a pretty challenging analysis to do, because geographic units have been changing over time, and there has been a lot of coordination to be done in order to use this data. But also, I've been using sociological measures, and I've been using the General Social Survey, for example, in several papers. So today, because we have, economists and we have sociologists, I see a great opportunity to actually sort of think about what could be useful from the different surveys. Like economists, have great measures of income, but on the other hand, sociologists have great measures of family formation, attitudes, networks. And I've always had, the problem of which one to use and how to use them, because they both have shortcomings. And I think that today we sort of have, these great opportunities of thinking about how and which variables and, could be, useful to make our understanding of, these are all economic, but also social phenomena, deeper. We're thinking about expectations, but then, we actually can use the sociologist, knowledge to think about how to incorporate all the things we know. About these different issues. Social networks is one, and the attitude is another one that, we cannot find in the e-books and would be very useful to attach to good, information about earnings, income, and household formation and migration, or that would be very, very helpful.
I couldn't agree more. When Professor Putnam was talking, I wrote "ad" in 2019. I couldn't agree more that adding some, if there is a short battery that the sociologists know about, that the economists should know about, please tell us what it is. So it can't be super long, but just in terms of thinking about people's networks, I agree with you absolutely. The long-term care example is amazing. So.
And I'll second that in terms of if there's other questions that, and with us, you don't necessarily have to wait till 2019, because we're actually start thinking about that sort of thing actually right now for our next year's survey. So to the extent that there are short questions, a short module, definitely let us know.
Yep. All right. Are there any more questions? Last chance? No. Okay, so I think I'm supposed to tell you we're now finished until 6 o'clock. Dinner will start promptly at 6. And it's back upstairs in the second floor dining room. And I just want to take an opportunity to thank everyone who came and presented today, and to thank our hosts for inviting us all here for what was a really fabulously interesting day. So.